Well, it's a very good morning from him, and of course, it's a very good morning from me. Hope you're all well. Hope all is good with you. Welcome to my Mortgage Insights, my mortgage live stream. Welcome to 25 minutes of mortgage updating and all those great things. Hope all is well with you and your business. Lots happening, of course, lots of changes. It's into July now, school holidays in a couple of weeks' time. So everyone takes their holidays and people slow right down. So now's your chance to upgrade yourself and upgrade your business in readiness for the autumn, whatever that brings. So we'll wait and see, because it's all go in our sector right now. No. Got a couple of topics for you today. I want to take a look at equity release and early redemption charges, because there's been no changes, but it's been highlighted by the gilt rates, what's been going on there. And I want to pick up on quite a topical thing for you. So if you're advising on protection or selling protection, no matter what you call it, then you might come across a few people that are going to balk at cost. So if cost becomes an issue, I'm going to give you 6 or 7 little tips that might help you to help advise and commit the customer to buying protection. But that's coming up a little bit later for you. So anyway, enough of that. Let's get on to our first topic, shall we? Because I got no sort of general updates really. The news hasn't been particularly good if you're a cricket fan, but we won't go into that, shall we? And the rugby season doesn't start till September for Gloucester Rugby, so we'll see what goes on there. And Man United have, I think they've bought a couple of players, but I'm not quite sure what's going on. Anyway, let's get into the first major topic, which is equity release and early repayment charges. And last week I ran 2 one-day workshops actually on the equity release exams for budding equity release later life lending advisors. And of course, these people are all qualified mortgage or financial advisors, so they know a few things. But redemption penalties confuse them somewhat because they're used to normal mortgage redemption penalties. So I wanted to explain to you how equity release tends to work. So let's head over to the whiteboard for this one, shall we? So let's just pop across here to the whiteboard. And as you can see, I've prepared early repayment charges for equity release. Now, when we're talking about equity release products, we're generally talking about lifetime mortgages, interest roll-ups. And the purpose, of course, of equity release, lifetime roll-ups, is a long-term solution. The interest rates are fixed for life at the moment, and the debt rolls up, of course, but it's not actually repaid until the person dies or goes into long-term care. We know that, don't we? But the point is that it's very, very, very long term. We're talking, for a 70-year-old, we can talk about 15, 20 odd years, maybe even more. People live longer nowadays, don't they? So we're not talking about a 2-year horizon. So the advisor's role here is to talk to the customer when you're doing your fact finding and stuff like that. Find out what the goals of the customer are and what their plans are for the future. I know it's not easy. Somebody who's 70, for example, may not know, but of course they do. And as long as you ask the right questions, so make sure you do a lifeline for the next 10, 15, 20 years. Are they going to downsize? Are they going to move to the coast? Do they want to be close to the grandchildren? Do they want to live in town near the doctors? Ask these questions. You need to know, because the whole point about equity release is there is a great big fat juicy early repayment charge on them, not like normal mortgages, because it's a full-time, like massive long-term fix. So how do early repayment charges work? Well, they vary from lender to lender. So of course you've got to look at the particular provider and what they're providing. But broadly speaking, there's 2 types. So let's get into to broad types, shall we? The first type is what we call the fixed early repayment charge, very similar to normal mortgages. Take a look at those in a second for you. And the second one is what's known as variable. So let's just put that out there for you as well. Variable early repayment charge. Now, the 2 types are depending obviously on the scheme you arrange, and it's how the lender finances their money. That's what it comes down to. Now, the traditional fixed mortgage, if you like, lifetime mortgage, is where the lender goes to the wholesale market. So let's just put the wholesale market in there. The wholesale money market, they get their money from the wholesale, just like normal lenders do. They obtain from there a variable amount of money. So the interest rate they're paying in the wholesale market is variable. As you know, they then put that over to the swap market and they swap it for a fixed interest. And the fixed interest, let's put it in there, is whatever the rate is. It varies according to the gilt markets, etc. We know that, but the wholesale market determines it. Now that, of course, is then lent to the customer. They lend that money to the customer or the client, and they add a little bit for a margin, percentage, or whatever, for profits and margin, but that's fair enough. And that's your standard rate. Now, they have standard early repayment charges. So, for example, you might have, your 1, 2, 3, 4, 5 years. And in year one, for example, it might be a 5% charge. In year two, 4%, 3%, 2%. And maybe after the fifth year, it might be a 1% or 0%, and then possibly the early repayment charges stop. So that's not a bad thing, and that's just like a normal mortgage. It's not difficult to understand, but of course there still is quite a high redemption penalty on that. Now, the other type is the variable. Now, the variable is a bit more complicated, and this is where the lender gets their money from the fixed interest funds that they house. So it could be an insurance company. Mostly they have fixed interest funds. So let's just put a fixed interest fund in there for you. Now, when we call it fixed interest, we're generally talking about the fund, a fund that invests in government gilt-edged securities, which of course are fixed interest, as we know. An insurance company has millions, billions of pounds under management in these funds, and all they're doing, as you know, is they're taking money out of the fixed interest fund, and they're lending it to somebody on a mortgage at a fixed rate. Simple as that. So they're lending it on a mortgage on a fixed base, a fixed mortgage. They're going to add a bit of margin for their profit, and that's how they lend their money, broadly speaking. Now, of course, the problem with that is that if somebody wants to cancel the mortgage, then there is going to be a variable early repayment charge, and that's where it gets a little bit confusing. Come on to that in a second for you, give you some examples. It's not as straightforward like 5, 4, 3, 2, 1%. Now, of course, early repayment charges on lifetime mortgages are not always charged. So, for example, if the person does die, or goes into a care home, they're not going to charge, are they? Often, if somebody reaches the age of sort of 88 or 90 and they want to redeem it, they don't tend to charge at that point either. And you're allowed to make capital payments on these things, 10% per annum nowadays, typically, without losing out. So you can pay your interest if it's allowed under the scheme. Generally, they are now. But you can also make capital payments of 10% a year without early repayment charges. So that's a good thing. A porting, you can transfer your mortgage from one property to another, typically, and there'd be no early redemption charges. But where they happen, you have to be aware, because it can be quite a large sum of money. So let's take a look at this system here in a bit more detail and explain a bit more on how this works. And then I'll give you a couple of examples. So what we're doing then, as you can appreciate, is lending the money to somebody. We're taking the money out of the fixed interest fund and lending it to somebody. We're putting it as security for property, and we're lending it on a mortgage. There's your mortgage. Now, the property obviously is very well secure, so it's as good as guaranteed as this. Nothing's guaranteed, but it's a very good secure lending. It's very long term, isn't it? And what they do is they take the interest that the fund is charging, and they basically use that, add a bit more for margin, and that becomes the interest rate they charge. It's not more complex than that. And therefore, they're making a profit, aren't they? That's how it works. But the problem they've got, of course, is if you decide to cancel your mortgage, if you decide to redeem your mortgage, later on down the line, they've got to move that money back into the fixed interest fund. And they say broadly that if they're going to have to do that, and by transferring your fixed mortgage into the latest fixed, if they lose out on that, in other words, that's a lower rate, then they're going to charge you an early repayment charge. So let's just give you an example to see how this works, because sometimes examples help, don't they? I've got a couple of case studies. The first one involves Myra. There you go. We've got Myra. Now, Myra is age 70. There you go. And she's taking out a mortgage, a lifetime mortgage, and she's taking out £50,000, or she took a £50,000 mortgage, and we'll go back a few years, in 2015. Now, when she took out this mortgage, 8, 9 years ago now, isn't it? She would have been quoted on her mortgage offer a FTSE UK gilt benchmark rate that was for her mortgage. So when she took her mortgage out, the fixed interest fund would have had a rate that the fixed interest fund was paying. And they used the FTSE UK gilt benchmark. And she would have been quoted on that. So her FTSE, let's put that in there for you, UK benchmark rate. There you go. When she took out this mortgage, and she would have had that on the mortgage offer, happened to be 3%. So that's broadly what the fixed interest fund was making. Now, her interest rate would have been more because there would have been a margin added to it. Now, this is why equity release lenders always publicise their FTSE UK. So let me give you an example of a FTSE rate. So let's head over here for you. Here's from my friends at AdviceWise. They sent me this through Monday. And as you can see, if I just zoom in for you, this is from summer 2023. The UK 15-year gilt rate is 4.52. That's the latest rate. So if anyone gets out a mortgage now, the lowest equity lease rate, as you can see there, it's just over 6%, but that's the lowest. It's probably about 7% now. As you can see, there's a 2 or 3% difference in margin and cost. So they're making a profit, aren't they? But it's that UK gilt rate that's quoted that's a really important figure. And right now it's 4.5 because, of course, it's been going up over the last few years. We know that. Now, she wants to redeem, she wants to redeem this mortgage, or she did redeem it in 2021. So obviously a couple of years ago. Now, when she redeemed the mortgage, the FTSE UK benchmark happened to be, and this is quite true, 1%. So what we're saying then is that when she decides to put the money, when she decides to redeem the mortgage in 2021, the insurance company are going to put her mortgage money back into the FTSE in 2021. They're going to make a loss. Do you see what I mean? That they lent it out when the UK benchmark was 3%, so she would have had quite a high interest rate, probably 4, 5, 6%. Now, of course, the FTSE is much lower, so they're going to make a loss. So they're going to charge a redemption penalty. And what they do, just to give you the numbers, is they take the £50,000 mortgage. Now they multiply that by the difference between the benchmark rate she had and the benchmark rate on redemption, which is, as you can see, 3% minus 1%. So that's obviously 2%. There you go. Let's put that in there for you. However, they then multiply it by the number of years that she's got remaining, pretty much. Now, when she redeemed it, she was age 76. Some do how many years there are from your age now until age 90. Some do slightly less. But if I did her age now, which is 76 when she redeemed it, that's then 14 years before she reaches 90. They'll then multiply that by 14 and then give you the redemption figure. So I did all the figures on that for you, and it came to just over 15 grand. That's a lot of money, as you can see, because of the way it worked for Myra. Now, let me give you another quick example. You can see how it's slightly different. I'll do this in blue, and I'll squeeze this in for you so you can see that. Number 2. Now, this one involves Raina. Now, Raina, there you go. Just squeeze that in for you, can't you? Raina took out a mortgage of 50,000. Okay. Now, Raina took out her mortgage in 2021, so during lockdown. And by the way, she's age 75, just for the ages. Now, what happened there is the benchmark, of course, in 2021 was 1%. There you go. So her mortgage would have probably been about 3% or something like that. Now, she wants to redeem it today in 2023. Obviously, look at the numbers according to when you're watching this video, 2023. Now, we could take a look at the benchmark over there, which I've got on my slide, which is 4.5%, wasn't it? So the UK benchmark was 4.5%. So obviously, gilt funds have gone up. Now, think about it logically. If she wants to redeem her mortgage now, and the insurance company will take her money away and put it into the gilt fund, so they'll start earning more money on the gilt fund than they would on her mortgage. Her benchmark was only 1%. So in other words, they will not charge a redemption penalty because they're going to win, aren't they? So it's all about looking at the UK benchmark when they took out the mortgage, and that's on the mortgage offer. And then when they want to redeem it, the UK benchmark then, if that's higher, you're okay. If it's lower, you're going to be stuffed with a great big early redemption charge. So the key here is to talk to the customer about it, particularly now with interest rates relatively frothy. What are we now? 4.5 benchmark UK gilt rate, so interest rates 7% or so. They're quite frothy at the moment. Whether they'll come down, I don't know. So you've got to be careful that any early redemption penalty will probably cost them a lot of money on the variable side. Obviously, you can go over here on the fixed side, but you probably find the interest rates are slightly more. So you've got to look at the options. So look at their time horizon. Chat to them about what they're planning to do. Will they redeem this equity release arrangement, or will they just leave it ticking away till they die or go into a care home, which is the purpose of the whole thing in the first place? They're not designed for shopping around, let's rebroke your equity release product. It doesn't work that way. It's a different type of arrangement. So I hope those examples helps you to understand it. So quite a lot going on in that whiteboard, isn't it? Hope that's been useful. Bye. Hey, well done, everybody. Well done. So a little bit of intense calculations going on there first thing on a Monday morning. So yeah, you need to know this stuff, and the exam, of course, covers all these things, isn't it? We're updating loads of our materials this autumn, not this autumn, this summer, in July, August. We're updating everything, boot camps, podcasts, and we have complete structured boot camp for our equity release. So if you wanted to just watch a load of videos rather than read a book, listen to some audios, we could teach you the equity release, and you could take the exam very quickly. Got a great boot camp available to anybody who wants to buy that from us. We've obviously got CMAT boot camps as well, and a protection boot camp. So we've got plenty of those going on. And our videos are pretty unique, actually. There's not many people that do videos like us online on demand. Anyway, enough of that. Let's go on to my next topic for you, which is protection. Now, there's an awful lot of mortgage advisors, mortgage protection advisors, making a living at the moment by selling protection. Customers have a need for it. There's client banks to go and talk to. There's people who can have an MOT. Their rates come up for renewal maybe in 6 months, 12 months' time. You can start talking about it now, and you should. And many advisors are talking about protecting clients, particularly if their circumstances have changed, etc. It might be that they're taking out a mortgage at the same time or remortgaging as well. And interest rates, of course, are going up, which means that people's affordability or their perceived affordability for protection is coming down. They might balk at paying 80 odd quid for some life and income protection because their mortgage has gone up by £400 as well. So it's a difficult one. You have to work with people on this one. So what I want to do now is give you a number of techniques that you can use to help the customer realize that it's going to cost a few bob, and they have to find the money to pay for it. So let's talk about some ideas. So I'm going to head over to this whiteboard here. So let's just pop here. Here's one I prepared earlier for you. And the title here, of course, is Selling Protection When Cost is an Issue. Now, what I've done is I put 3 parts to our protection selling. When you're selling protection, advising on protection, there's structure to follow. Of course, there is. Now, I've got 3 parts here. We've got sowing the seed, which is part 1, coaching the protection gap. That's the fact find. And here is presenting the package. So when you're advising on protection, they're the 3 steps you should take. Now, this could be alongside a mortgage, or it could be on its own. It doesn't really matter. So sowing the seed is when you are just introducing yourself and you're putting across your proposition, what you're all about, etc. And there's many things that we talk about in that one. But one thing we talk about there is to sow the seed as to what you do and how you operate. In other words, you are a mortgage and protection advisor. Your job is to arrange the right finance for people, but also to make sure they get to keep the house in the event of anything that's thrown at them, life throws them, like death, illness, that sort of thing. We want you to keep your property and have a mortgage protected. So that's my job. That's what I do. So you've got to still do that. But what we like to do now is start to talk about affordability. We talk about budgets at this early point. And many mortgage advisors in the first few minutes of discussion will talk about customers' budget, really. You're looking to buy this house, what sort of budget do you have in mind? And many people have worked around rent, for example, or sort of a monthly payment. They think they can pay for everything. And they try to include the protection in this budget, like a whole budget. It's a very good thing to do. And the kind of things you can talk about at this point is, well, you could certainly talk about other things that people protect, because you're talking about contrast here, aren't you? What else do they protect? Do they insure their car? Do they insure their house? Do they insure their pets? You can certainly look at the protection sort of subject, can't you? But it's important to assert the point here now that protection is going to cost some money, and it's about sacrificing things in their life. Looking at their net disposable incomes, have a discussion around that as well. If the initial budget they give you is quite low, you might want to start bidding that up a bit. Oh, great, interest rates have increased since your last mortgage, so you really will be wanting to look at a slightly higher monthly payment for that one. The ballpark figure for that would be about this. How does that sound? Oh, that's a lot of money, isn't it? Well, that does include your protection as well. What else do you protect? You have protection for things like your house, your car. It's going to cost a few extra pounds to cover that now. So just getting them used to the fact the budget the budget they're going to give you needs to be a lot more probably than what they're working towards. So that's the first thing you want to do, is start talking about the budget when you're sowing the seed, but also the fact it's going to cost a little bit more. Sometimes in life you have to make the odd sacrifice. Sacrifice your morning latte, for example, because there's more sugar in a latte apparently than a cream cake. I read that the weekend. So you could certainly talk about that. Get them used to it. That's all. You're just preempting their thoughts. You haven't even given any quotes yet. Of course you haven't. The next thing you start to do then is coaching the gap. Now, this is where you fact find to find out, what happens to them, because they've got this amount of cover. They need that amount of cover. There's a big gap. If they don't fill the gap, there's going to be trouble ahead. That's the whole point behind it. And we ask that you have an affordability discussion. You might do an assessment, a proper decision in principle thing if you're remortgaging, and it's then that you start talking about other things. Now, when you're fact finding and you're asking questions about their age and their occupation, you can chip in little things. So, for example, let's just put a little idea. You can chip in when you're fact finding. Fact finding. Their age, just put their age, their occupation. You could say so. Oh, you're very you're very young, aren't you? That means your any costs for life insurance is going to be really low. That's good news for you. Or if they've got an occupation that's quite dangerous, because well, actually that occupation's quite dangerous, isn't it? So protection costs can be slightly more there. So we might need to look at maybe increasing your budget for that. So you can have a conversation about costs as you fact find. Again, all you're doing is you're getting their mind used to the fact it's going to cost a little bit more probably, or they need to find some extra money to pay for it. Now, when you're protecting or when you're coaching the gap and you're talking about the effect of them dying and what's going to happen to the kids, etc., you can certainly talk about protecting yourself might cost a few extra pounds than you thought about. So if this is important to you, have a think about how much extra you could pay towards this. You gave me a budget of £1,100 to start with yesterday. Is there any more that you could find to be able to make sure you're fully protected? Another £50, £75 maybe in your mind? Okay, we could probably squeeze another 7. Okay, so a budget of £1,175 then is what we're looking at now, is it? Yeah, that's right. So you certainly want to, if you like, refresh the budget they gave you earlier as you begin to fact find, particularly as you're coaching the gap. Because when you're coaching the gap, they start to realize the need for the insurance and the impact it will have on their life. So start to refresh the gap at that point. The other thing you can do towards the end of coaching the gap, and we call this the vicar close. I talk about that quite a lot, don't I? The vicar close. This is where you're gaining commitment from the client without seeing any numbers. You haven't done any options or quotations, have you? And here you might sort of say something like, if I get some great ideas together for you and look at some costings, if the total cost is a little bit more than your budget, how would you feel about still going ahead with that? That's what we call the vicar close. What you're saying to them is, look, I'm going to do some quotes. I know from my mind that it's going to be high because of your age, etc. And if they are slightly more than what you've talked about in your budget, would you still be wanting to go ahead? That's all you're saying. You're not saying, here's the numbers. Do you want to go ahead? You're saying, look, I'm going to get some ideas together, some options, some quotes, whatever. And if they are a little bit more than what we've talked about, your budget, monthly budget, how would you feel about that? Are you still wanting to go ahead with that? So in other words, you're doing a vicar close because you haven't even shown them the details yet. When it comes to presenting the package or whatever you want to do, a lot of advisors use sweet spot pricing. Sweet spot pricing. I've talked about this before. Now, sweet spot pricing is where you have three different prices, don't you? You have your platinum, your gold, your silver, what do you want to call them? It's three, really, really expensive, a massive platinum everything you ever, like a CMAP version, costs hundreds of pounds. Then right at the bottom, you have this really cheap and cheerful one, with no bells and whistles, completely bolted down to be the cheapest possible, really sort of like irksomely cheap. And then in the middle, you have a plan that fits the budget, that gives them the cover they need. Might not be everything they would like in an ideal world, but it does give them the right amount of cover that you've spoken about within ish the budget that you talked about. And of course, you then can look at, which one would you like to go for? And people tend to go for the middle one because that's the way people roll, isn't it? I mean, keep the cost down. Take a look at multi-plans, for example. So find an insurance company that does income protection and life combined or something, or critical illness and life combined. Try and bring the cost down that way by doing a multi-plan to keep the fees, the monthly policy fees down as well. And if you want to express it in a bit corny, but express it weekly if you want to, or daily. It's a little bit corny, isn't it? Rather than £100 a month, you could say, well, this is just over £3.25 a day. The cost of a latte, actually, it's probably cost of half a latte, isn't it? A bit corny, but it does bring it to life to people. Of course, the whole point is you're presenting a whole budget. If it's a mortgage and protection, the whole thing together. It's all about the budget at the early doors. That's the key. And mortgage advisors tell me that when they get a budget early doors and the budget is enough, they can tend to look at a good recommendation later down the line, because you're just preempting the customer's mind, aren't you, to think about that. Here, remember, you want to do something about bidding up that budget. You want to encourage them to think about it a little bit more very early on, before you even talked about the gap, etc. Get them used to the fact they need to be paying a little bit more money as well along the way. And at the end of the day, I think personally that it all comes down to the gap, isn't it? If the customer sees the need, they really do understand what's going to happen to them if they die or become ill, and they've got kids and they've got house, etc. They need the protection. And they understand that. It's all about cost benefit analysis, isn't it? Yes, it's going to cost them, but there's a massive benefit to them. But if they really can't afford it, of course, and they want to go online and get it cheaper, then you can do ways of bringing it down, maybe, or at least bidding up the budget, maybe sacrificing some of the other things they pay for in order to get protection. So it comes down to the assertiveness of your advice. Hope that's been useful for you. Bye. Hey, hope that's been good as well. Protection is really important. I spent many years as a mortgage and protection advisor selling protection to people. I found it incredibly valuable. The best thing, if you ever get a chance to it sounds terrible, but if you deal with a claim, a life claim or something, critical illness claim, and you start to see the difference it makes to people's lives. Obviously, if they've lost somebody, it's terrible, but at least they've got a bit of money to make ends meet. Or the critical illness claim is often easy enough because obviously they're still alive, aren't they? Or an income protection claim where they're definitely still alive. At least they're getting money coming through. So when you see that personally as an advisor, you start to realize the impact. But these things do need to be sold. They do need to be, customers need to be encouraged, persuaded, influenced, call it what you like, or sold to. The fact is, they need it. They need to be influenced to take it and to be able to afford it. And people need to realize sometimes that they have to make sacrifices for their mortgage and protection. Everyone's moaning about it, interest rates going up. Of course they are. And it's a huge amount of money for lots and lots of people. I get all of that. But one lender was quoting at the weekend, I think must have been the Nationwide, they said all their mortgages in 2022 were stressed at 7%. So people have been stressed at these rates, which means that in theory they can afford it, but they have to cut back on things, on discretionary spending. And it won't be nice for a couple of years. Times will be hard. Holidays have to be cut back, weekends away. You won't be able to eat out so much anymore. It's hard to say that, but it can be done for quite a few people. I think it's down to us to help people to realise protection is an absolute imperative. If they don't have that, it could be even worse for them. Anyway, lecture over for the week. Okay. All right, let's wrap up. We've been going for half an hour today. It's quite a long time, isn't it? A couple of good sessions, I hope. Lots of things going on. Remember to get onto our member database. I talk about that all the time, or our member list, as we're now calling it. If you wanted to head over to this slide, you can take a photograph of that one and scan that barcode. That'll take you into our member list. And if you're on our member list, then of course you get all the goodies that are coming up. We've got Saturday morning podcasts for free as well for our members. I'm doing a how to be a successful mortgage advisor series of videos during the summer as well. Lots of free stuff coming your way if you want to sort of log on and attend live. So get on our member list and we'll be able to help you with all those things. Other than that, I wish you to have a fantastic week. I'm sure you will do. I'm sure you'll have a great time. Enjoy the weather and things, and kids go off school in a couple of weeks' time. I'm sure you're looking forward to that if you've got kids. If you haven't got kids, you're probably not looking forward to it, are you, at the end of the day? Anyway, enough of that. I'm Paul Archer. I'll see you next week. Bye.